And hello once again, options traders. Welcome back, everyone. Well, I recently posted a video on morphing, and in that video I talked about potentially using a debit versus a credit spread based on a potential morph. And it never fails. It's like clockwork. Every time I talk about debit or credit spreads, somebody emails and says, hey, wait a minute, isn't the credit spread better? Because after all, it's better to receive money rather than to spend money. Well, first of all, if that was true, there would be no reason to even have debit spreads. It would not be a strategy. But there's more to it than that. And so what I thought would be interesting in this video is to show why, at a detailed level, what's really happening when you use a credit spread. And the answer might actually surprise you. So first of all, debit versus credit. Unless skews are present, there is no difference. Take your choice. Debit, credit, it's not going to make a bit of difference. Again, unless there is a skew that's giving you a mathematical advantage. And as I also talked about in a recent video, it might be due to a morph. And that might make us lean towards a debit or a credit. But you don't want to choose a credit spread just because of the word credit and this false belief that somehow it's better off. Debit and credit are accounting terms. They are not trading terms. Yeah, the credit comes from the fact that the difference between those two options results in a credit. Or the debit comes from the fact that the difference in those two options is going to result in cash going out, or a debit. But what traders don't realize is that when you have a credit spread, that credit comes from borrowing money. That's right. The reason you're getting the credit is you're also attaching borrowed money to the trade. So for this video, I'm going to compare two different spreads, one using all calls and then one using a combination, which will give us the credit spread. So as a refresher, if I build a butterfly spread with all calls, it will consist of a debit and a credit spread, but the debit spread will be the bigger trade. So on a net basis, it is a debit spread. And that would be true if I built it with all puts. I can also build a butterfly spread by using a combination of calls and puts. And that's going to result in a credit spread because both of these vertical spreads that we're putting on are credit spreads. And this is what we call a short iron butterfly. So I was talking about a short iron butterfly in a previous video and of course received emails where people were saying that's got to be better because it's a credit. And again, what I want to show you is that between these two, the all call version versus the combination using calls and puts, or the short iron butterfly, that you're really just borrowing money. So to do that, we have to take a little sidestep here and talk about box spreads, which I've talked about in a previous video. But a box spread is one of many what are called locked trades. In other words, the value isn't going anywhere based on what the underlying is doing. So for instance, let's say we've got calls on the left and we've got puts on the right. Here's the strikes down the center. I'm going to use a notation that if we are long a call, I'm going to put it under the plus column for the calls, and we would be short a put over here, and that trade by itself is a synthetic long position. Now again, notice I'm using a green and red combination just to accentuate it so you can see the long and the short. That's a synthetic long stock position. To complete the box spread, I would need to short the 55 call and go long the 55 put. And that trade by itself is a synthetic short position. So think about it. If you are long stock at 50 and you are short stock at 55, you made $5. So if I put on a box spread like this, we know for a fact it will be worth $5 at expiration. So it's going to be discounted somewhat today. Maybe it's trading for $4.90, let's say. So you would pay $4.90 and collect $5. So in a way it behaves like a T-bill. So the first thing to understand is that because it's a guaranteed trade, there's not going to be a lot of profit in it. But still, the box spread is a very useful tool for legging into positions, out of positions, and parking cash. Whenever you buy a box spread, you are lending money to the market. Very much like if you buy a T-bill, you're lending money to the government. Well, if we can lend money, we can also borrow money. And we do that with a short box spread. It's just the opposite. So let's say we sell the $50 call and buy the $50 put. That is a synthetic short stock position. Then to complete the box, I would buy the 55 call and sell the 55 put. And that is a synthetic long. So think about it. If you're short stock at 50 and you buy it back at 55, that's a $5 loss. But you received a credit for putting this on. So in my example, yeah, maybe you received a credit of $4.90, but you owe $5 in the future. You've borrowed money. So take a look at this pattern right here. This is a short box spread, and this is what you're actually doing when you use credit spreads. So let's take a look at this credit butterfly. When you do this, you are actually using a debit butterfly, and you're combining it with a loan. And it's the loan that creates the credit. So you shouldn't say that you're better off because it's a credit if part of that credit is coming from the fact that you're borrowing money. So let's take a look at how that would show up on our maps right here. The debit butterfly by itself, if I bought the call butterfly, would look like this. I'm going to be long a 50 call, I'll be short 2 of the 55 calls, and I'm going to be long a 60 call. Now for this slide, I'm going to do away with the reds and greens for longs and shorts just so you can see the two positions more clearly. So in blue, we have a long call butterfly. Let's overlay the short box spread on top of it, and that is going to be this in all red. So if we combine these two, take a look at what happens. Right here, I've got long a call and short a call, so they are going to cancel. They just get wiped out of the account. Down here, I'm long a 55 call and I'm short 2 55 calls. So when we combine those, it's just going to leave me with 1 55 call right here. So after the trade is done, I'm just going to be left with 1 55 call. What are we left with? Well, take a look. Over here is a short 55 call and a long 60 call. That is a credit spread. What's this over here in red? We are short the 55 put and long a 50 put. That is also a credit spread. This right here that you're looking at on this screen is a short iron butterfly. So again, the reason that we got it is that it was really a debit spread combined with a loan from the market. So I know it still looks kind of weird and people say, I don't know if that's actually quite right. Let me show you on an Excel spreadsheet what's actually happening. Okay, so now we're into an Excel spreadsheet, and I'm going to use the same strikes here, the 50, 55, and 60. I have a column for calls and puts, and the numbers in here are generated from a pricing model. And I've done that because we're going to have to go to several decimal places, otherwise we're going to get rounding errors. So these are the theoretical prices. Over on the right, we're going to start with the debit call butterfly, and to add some further clarity, I'm going to assume that we're going to do 10 butterflies. And that's just going to help us get rid of some of these little pennies out here. So we're going to be buying 10 of the 50s, selling 20 of the 55s, and buying 10 of the 60s. And if we do that, these would be the resulting prices. And if we net them together, we end up with 26.319 for a debit. What about the credit spread? Well, we have 2 credit spreads as part of a short iron butterfly. Right here are the puts. We're going to be selling the 50-55 put spread 10 times, and that's going to give us a credit of 11.615. Down here, we're going to be selling the call spread. I'm going to sell the 55-60 call spread 10 times, and that will bring in a credit of 12.042. So on a combined basis, we get this nice big credit of 23.657. And this is where all traders, or at least most of them, stop and say, hey, look at this. It's better to have a credit of 23.65, let's call it, instead of spending 26.32. Well, we're not done yet. We're far from it. Let's take a look at the max gains. If you spend 26.319 for this spread, the most it could be worth is 5 points. That's the difference in these strikes. We did it 10 times, so that's $50. So if you spend 26.319 and you can close it for 50 at best, that's a maximum gain of 23.681. On the other hand, if you sell the spread, this credit spread right here, that's the maximum you'll ever get. That's true anytime you sell an option. So this trader's maximum gain is 23.657. Now let's compare. The debit spread trader can make 23.681, a little bit more than the credit spread trader. How much more? Well, if we subtract them out, it's about 2.4 cents. So why is the debit spread trader coming out a little bit ahead for the maximum gain? That's because the credit spread trader also sold this box spread. So let's take a look at that down here. If we go through those 4 pieces of a box spread, we would find out using these prices, it cost 49.976, and the trader would owe 50 at expiration. So if you spend 49.976 and you owe 50, you've essentially paid 2.4 cents in interest, exactly the amount of the additional gain to the debit spreader. So it's again the reason that the debit spread trader came out ahead a little bit is because the credit spread trader was having to pay this interest. They effectively borrowed money. There's another way we can look at it. If the credit spread trader receives 23.657, but also receives another 49.976, it's kind of unfair to say that this person generated this extra money down here just because there was something special about the iron butterfly. It wasn't. They just attached a short box position to the trade. So let's back this out. Let's take 49.976 minus the 23.657 credit, and we get 26.319 as a net debit, exactly what the debit call butterfly spent over here. So there actually is no difference whatsoever. So the main thing to understand is that if you're especially new to options and to spread trades, you've got to get out of the habit of thinking that credit spreads are better than debit spreads. They might be if there's a skew present or if there's a potential morph, but you don't want to put the credit spread on based on a false belief that somehow that credits are better than debits. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsato-z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.